Hello guys, today we are going to talk about one of the most famous books in the financial world, called it When Genius Fell. When Genius Fell was written by Robert Lowenstein. Now let me guide you through a short story of this book. When Genius Fell chronicles the rise and fall of what was considered the best and largest global hedge fund, or long-term capital management. The irony behind the collapse makes the story very especially intriguing, despite the brightest mind in finance, including the top two Nobel Prize winners as Robert Merton and Marion Challis. The fund started with $1.3 billion going through its peak at $140 billion before it eventually crashing to ruin. Now let's start with the story. In 1994, John Meriwether, who is the genius of the fixed income arbitrage and the vice chairman of Salomon Brothers in 1980s, he would like to start a fund by himself to gain more money. So Meriwether invited the top two Nobel Prize winners, which is Robert Merton and Marion Challis, to start a fund called it Long-Term Capital Management, or LTCM. The LTCM started with the $1.3 billion as the initial fund, going through the strategies of the absolute return trading strategies, which is the long position only and no short. They're going through this strategy through a derivative. At that time, when Meriwether invited the top two Nobel Prize winners, Robert C. Merton, he's a professor at MIT Sloan School of Management, and Marion S. Challis is a professor of finance emeritus at the Stanford Graduate School of Business. Both of them are well known for the originator of the Black-Scholes option pricing model, which got the Nobel Memorable Prize in Economic Science. To start a fund with $1.3 billion, Meriwether asked the high net worth individual personally to come and invest in his fund. With his fame that is well known in the financial world, he has successfully gained the initial fund. After he successfully gained off the initial fund, he started his fund in 1994 and gained the returns of 28%. After the fee, the fund still gained 20% in returns, and this going through its peak in 1995, which he got a 43% in returns for the fund. And from this, in 1998, the fund collapsed with a negative 92% in returns. Taking a look at what's happening in 1994 until 1998 from the start until the end of their fund. In 1994, there's the Mexico Triangular Crisis, which is the financial crisis in Mexico. They did a very good performance in handling their portfolio, which gained a return of 28%. In 1995, there's the boom in derivative contract, which they are invested in, give them the highest and the peakest return by 59%. In 1996, they start to invest in Japanese convertible bonds, Italian bonds, junk bonds, and interest rate swap, which give them a very good performance. Until the Asian financial crisis approached in 1997, which crumbles their returns. Eventually, in 1998, the Asian financial crisis spread out to Russia, and Russia started to default on their own debt. This gives the portfolio management of the LTCM to have a negative of 92% in return. This is due to their wrong strategy in investment, that they invested in Russia because they believe that Russians shouldn't default on their own local currency debt. Even more than that, they have more than 7,600 positions worldwide which they couldn't manage, and this resulted in the collapse in the LTCM.
So after LTCM failed to raise more money on its own, it became clear it was running out of options. So on September 23, 1998, Goldman Sachs, AIG, and Berkshire Hathaway offered them to buy out of the fund partners for $250 million to inject a $3.75 billion and to operate LTCM within Goldman's own trading division. The offer was stunningly low to LTCM's partners because at the start of the year, the firm had been worth $4.7 billion. Warren Buffett gave my revelers less than 1 hour to accept the deal. The time lapse before a deal could be worked out. So the risk associated with this case is the excessive over-leverage risk. So this type of risk can occur when an investment is financed on the basis of following. First is a very small amount of own capitals, or we also call the equity. Second, an excessive amount of borrow money. And last but not least is the full uncertain gain or risk prospect. It can also be called capitalism without capital, as it plays mostly with other people's money such as bank loans and bonds issuing, and use the least possible one's own savings or at least equity financing in the whole. Now, other often hidden ingredients of financial derivatives. Those tradable assets or contracts create debt commitments that are either potentials as linked to the variations of some market prices or indirect. An intensive use of such not too visible market instruments by an institution or business makes it difficult to get a right picture of how this entity is leveraged, and therefore of the financial risk involved. Now we come to one key question that I believe that each and every one of you ask yourself. What makes over-leverage attractive in the eyes of the investors? Now when everything works nicely and the investment profitability is above the interest rates paid on the debt, this practice boosts the investor's incomes or gains, but also its losses. For example, if the asset gives a 10% return and the debt costs 5%, the investor pockets the difference. If its commitment on a 1 million investment was only 20%, therefore 200,000 pocketed. The lenders of the 800,000 gets the 40,000 interest, and the investor gets 60,000, therefore a 30% return on its 200,000 investment. If on the other hand, the asset return is only 4% at the end of the day, the same calculation shows that the investor does not gain 1 kopeck. And if it is under 4%, it will have a negative return, and the lenders will repay themselves on a piece of its equity. This trick is sometimes used to create artificially, and hopefully, if things turns out well, what is called shareholder value. But for any glitch such as loss of revenues, higher interest charge, unforeseen accident, or financial need, can make that practice ruinous, making it impossible to face debt charges, interest, and repayment when incomes are not large enough. The default is made worse and a rescue becomes highly improbable if the asset that was pledged has lost market value, so that its sales does not cover the amount of the outstanding loan. The mortgage supply disasters comes here again to our mind. This makes over-leverage one of the factors that's explained first at the macroeconomic level. Many individuals and corporate bankruptcies, even a wealthy person or a profitable business can suffer a liquidity crisis. Now at the macroeconomic level, result in most financial crashes. Leads to financial crisis. Usually such a risk pyramid ends in deleveraging, a soft or hard landing in which players with excessive debt sell assets to repay them. They do it under their own initiative or under a bankruptcy process that cancels at least partially those debts. Lenders might also agree on a debt restructuring, accepting a haircut on the debt value. People with real own capital buy those assets at rock bottom price, and if necessary, they bring more equity to alleviate the debt burden. Far from being the end of capitalism, there's a drastic back to capitalism phase. So the key factors which contributed to that evolution that is largely responsible for the financial and economic troubles of the last decades were: first, of course, the debt versus equities gains in business financing. Second, the excessive use of esoteric financial techniques not really mastered. Thirdly, the expansions of sovereign debt. And last but not least, and as the main drivers of the global financial hurt and a common source of the overflow, the laxity of official bodies, notably the US Treasury and the Federal Reserve Board, the US Central Bank, bail them out all the time. Thank you for your attention, and if you want to know more about financial industry, don't forget to subscribe below, and we guarantee that we will have a lot of nice information regarding the financial industry ready for you. Thank you very much.